Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, May 18th, and today's theme is simple. Energy headlines are back, bond yields are loud, and markets are trying to pretend they're fine.
Markets are doing that thing where they say, I'm totally chill, while their eye is twitching. If your portfolio could talk, it would ask for a glass of water and a paper bag.
Story 1. Oil prices climbed and bonds faltered as the Iran war raised inflation fears. The key point is the market is repricing higher inflation risk fast because energy is the quickest way to reheat the CPI narrative.
Gas gets spicy, and suddenly everyone remembers they hate inflation. My wallet just filed a formal complaint.
Here's the simple finance behind it. Imagine the economy is a household budget. Energy is like the mandatory subscription you can't cancel. When that bill jumps, companies face higher costs, consumers have less leftover cash, and inflation expectations can lift, pushing bond yields up.
So oil is the unskippable streaming service that keeps raising prices and adding zero new features, except the feature is your commute costs more.
Why it matters for normal people. Higher fuel can bleed into shipping, flights, and groceries. And for investors, rising yields can pressure stock valuations, especially the expensive, growthy parts of the market.
I know you're about to say don't panic, but let me panic responsibly. What's the real-life move here? Do I just stop driving and become a person who owns a bicycle pump?
3 practical moves. 1. Check your cash flow sensitivity. If gas and utilities rise 10-20%, what breaks first? 2. If you're investing, avoid being over-concentrated in long-duration assets that hate higher yields. 3. Keep dry powder. An emergency fund and a disciplined buy plan beat doom scrolling.
Okay, but the market is also doing that AI is the future thing while yields rise. That's like trying to do yoga on a trampoline. What's the latest?
Story 2. A Market Pulse note said inflation fears are fueling a bond yield surge, with investors worried the Fed could eventually talk hikes rather than cuts. It also flagged extreme concentration in the AI-driven stock rally, valuation pressure building ahead of major tech earnings like Nvidia.
So everyone piled into the same AI trade, and now the bond market is yelling from the other room. Classic. It's like the whole party is in the kitchen until someone notices the floor is on fire.
Exactly. The finance concept. When yields rise, the discount rate rises. Future profits become worth less today, which hits high multiple stocks hardest. If the rally is concentrated, a small shock can ripple through indexes because the same names carry the weight.
I'm going to disagree a little. People say concentration risk like it's new. Markets have always had favorites. Maybe the AI leaders are just actually good?
They can be great businesses and still be risky at a given price. That's the reversal people forget. A wonderful company at a stretched valuation is like buying a great house during a bidding war. Still a great house, but your margin of safety is gone.
Fine, you got me. I've overpaid for concert tickets and called it an investment in joy. Same energy. So what's an actionable fix? Sell everything with the letters A and I in it?
Not sell everything. Rebalance. Cap single stock exposure, diversify factors, and stress test your portfolio for a 1% yield move. If you can't sleep through that, your risk is too high. Also, consider adding assets that historically hold up better when inflation fears rise, without pretending anything is a magic shield.
Speaking of magic shields, Elon Musk says SpaceX IPO pretty soon. That's either a moonshot or a chaos grenade for my watch list. What do we know?
Story 3. Bloomberg reported Musk saying they've got to get the SpaceX IPO going pretty soon, with people familiar suggesting a filing could come as soon as this week. If it happens, it could be a massive liquidity event, pulling attention and capital across markets.
So my retirement plan is now rockets. Love that for me. But seriously, does a mega IPO help or hurt regular investors?
Both, depending on behavior. It can expand access to a high-profile company, but it can also tempt people into buying headlines. Actionable checklist. Watch the valuation versus fundamentals. Understand lockups and share structure, and decide your max position size before the first trading day, because "I'll be disciplined later" is not a plan.
My max position size is whatever I can afford to regret in peace. But I hear you. Set rules before the hype hits. Also, if oil stays up and yields stay jumpy, I'm meal prepping and emotionally hedging.
Quick recap. Oil headlines can revive inflation fears fast. Rising yields can pressure high valuation stocks, and a potential SpaceX IPO could shift liquidity and sentiment. If you want one move today, map your budget and portfolio to higher for longer risk and rebalance before the market forces you.
And subscribe to BD Daily Finance News Podcast, because nothing says self-care like understanding why your index fund is having feelings. Drop a comment. Are you hedging, holding, or hunting bargains?